Hello and good evening. My name is Chris Ward, and I have the honor of representing the 78th Assembly District, including most of the city of San Diego and the northern part of the city of El Cajon. And it's great to be back full time with you in our district. We've concluded the legislative year early September. I've been meeting with community members and putting on several community events, and I want to thank you for attending today's webinar to discuss insurance issues and tips for Californians. This is one of the top topics as I meet with constituents today, and we organize this webinar to help many like yourself receive information and have some of your questions answered. I'm thrilled to have the California Department of Insurance with us to discuss where things have gone so wrong with insurance fundamentals, some of the options available to you now to protect your family and property, and what we are working on in the state to correct some of these fundamentals so insurance premiums can be reasonable and policy coverage stronger. As many of you know, our state has been facing a crisis in the market, leading to detrimental impacts on people's daily lives. I've heard directly about the growing reports regarding our community members' ability to gain, retain, or reasonably afford home insurance. No one should be priced out or dropped from their insurance without notice, and I hope that some of the information provided today will assist you in navigating many of the options available. It's important to understand some of the convergence of factors that have left the market how it is today, but for all of you to be empowered with the knowledge of what is being done at the state level to address these issues. The legislature, my colleagues, and I have increasingly engaged with our insurance commissioner to pass on your experiences and look for solutions. The Department of Insurance has been working on a major overhaul of our state's insurance market, ensuring that it would thrive for the benefit of all Californians while addressing the escalating climate crisis contributing to risk. The department's recent work on California's sustainable insurance strategy has been a landmark change to consumer protection and insurance market sustainability. Our presenter for today will get more into the detail on some of the efforts during her presentation, but I want to highlight how important this work has been and our commitment to do more. As we just finished the legislative year in Sacramento and look forward to next year's session, I'm optimistic for our continued collaboration with the Department of Insurance to build upon California's sustainable insurance strategy. It's important to all of us that we address this as quickly as possible to help the cost, availability, and necessity for home insurance for all individuals living here in San Diego. I hope that today can be a resource to all. The webinar will also be recorded and available on my website this week so that you can look back on information you might have missed and importantly, share this with others. Now I'd like to introduce you and offer a big thank you to Sharon Smith, our local outreach analyst with the California Department of Insurance, for presenting today and providing some of the important updates about the state of insurance in California. There will be time for a question and answer portion at the end of her presentation, so please feel free to use those in the Q&A section at the bottom of your screen in the Zoom. And I want to hand it off to Sharon with the California Department of Insurance to get started on her presentation. Thank you for being with us.
Thank you so much for that introduction. As we all know, insurance is a huge hot topic right now, so I'm really glad to be able to be here and giving out this really important information. Again, my name is Sharon Smith. I'm an outreach analyst for the California Department of Insurance. I'm based here in San Diego. I'm the local representative, but I go all over to Imperial Valley up to South Orange County. And today I really want to talk about what we do at the department. I'll give a brief overview of a typical homeowner's insurance policy, what it covers, what it doesn't cover, make sure that you're not underinsured, and then also some steps you can take if you can't find insurance, and again, what the department is doing to address this growing insurance crisis. Right, so the California Department of Insurance, it's also known as the CDI, we are a state agency. So we don't sell insurance, we don't promote insurance companies. Our priority is consumer protection. So the CDI plays a crucial role in maintaining a fair and safe insurance environment for consumers by regulating the insurance marketplace. We can help ensure that policyholders have access to reliable coverage while addressing issues like fraud and consumer complaints. With Ricardo Lara, pictured right there as our insurance commissioner, the focus remains on protecting consumers and ensuring that insurers remain solvent and compliant with existing laws. So it's also important to note that while CDI sets standards for agents and brokers, we can't actually make new laws or significant changes. Those regulations would need to go through the legislative process, but the sustainable insurance strategy that I will talk about is a lot of those reforms that we are able to do, but the structure kind of helps balance the need for oversight with the need for a legislative process. So, given the importance of consumer protection and understanding the regulations surrounding insurance, I thought it was really appropriate to take a look at a typical homeowners insurance policy. So it's also known as an HO3 sometimes. So 15, 20 years ago, if you were buying a home, insurance was almost an afterthought, right? So it was a check off the long list of things you had to do before you closed on your home. But the market has changed, and navigating the details of insurance can be overwhelming. And especially if you're a first-time homeowner, you might not prioritize insurance in the midst of a new huge purchase like a home. So first, to break down a HO3 policy, a typical homeowner's policy. It's going to contain two sections. So your section 1 is going to be all of your property coverages. Section 2 is going to be your liability coverages. So coverage A is going to be your physical dwelling itself. So this is going to be any major property coverage that protects your house and anything attached to the home. Coverage B is going to be about other structures. So anything detached, maybe the tool shed in the backyard or anything outside of your home is going to be covered under coverage B. Coverage C is going to be personal property. So this is going to be protections to the things inside of your home. I had an insurance agent basically described as if you turn your house upside down, everything that would fall out is going to be under that personal property coverage. And you might want to consider to have additional coverages if you have really valuable items, jewelry, collectibles, antiques. Those types of things are usually require some additional coverage than a typical personal property coverage. Coverage D is the loss of use. So this coverage will help with additional living expenses if your home is damaged by a peril, insured against to the extent that you cannot live in your home. So these expenses are sometimes hotel stays or housing, meals, warehouse storage for your belongings. So anything within those assisted living expenses are going to be covered under loss of use. The last section 2, the liability coverages, coverage E is personal liability. So this is the section of your homeowner's policy that's going to provide coverage in the event of you or a resident of your household is legally responsible for injury to others. So if there's any legal fees associated, coverage E, personal liability will handle it. And then the coverage F, medical payments to others, covers any medical payments associated with your health insurance. So all of these exclusions and specific language are going to be very specific to your policy, but definitely locate it, look it over. They're going to vary policy to policy, insurance company to insurance company, but it is important to just have a basic understanding of your policy to know where the gaps in coverage might be if you're underinsured in some parts or not. And if you don't know, if you're looking at your policy, you're like, I don't know what any of these letters mean, you can always contact our department. I've included the contact information at the bottom of all of our slides, but we will go over the policy with you line by line. So there's many perils. Perils is just some sort of catastrophe or reason for a loss that are not covered by a typical homeowner's policy. So typically covered is going to be something like fire, lightning, windstorms and hail, explosions, theft, smoke damage, vehicle damage, something like that. Those are the things that are typically covered in the policy we just went over. But a lot of things are not covered. And a lot of times, many homeowners don't know that they don't have those coverages until something happens where they have a loss. Flood, for example. Most flood insurance policies in the United States are actually provided through the National Flood Insurance Program. They're not usually provided through your private homeowners insurance. And this flood insurance program, NFIP, look up the website if you would like it, more information there, but that's managed by FEMA. So the flood insurance program is a national program. It's not going to be covered in your typical policy. Earthquake and earth movement, again, especially in California, not something that's typically covered in your homeowner's policy. You would have to have a separate earthquake policy. And some insurance companies will sell you an earthquake policy. Some will sell you an earthquake policy under the California Earthquake Authority. So the CEA, this is going to be the nonprofit organization that provides earthquake insurance in California. And you can contact your agent for more information on the earthquake insurance part of it. Water damage from any type of sewer backup or a drain flow is also often excluded from a standard homeowner's insurance policy. And this can lead to huge out-of-pocket costs if not addressed. Repairing water damage can be really extensive. Sometimes you're cutting out drywalls and replacing baseboards and flooring and cabinetry. And all of these repairs can accumulate really fast, and it can have the potential to cost you tens of thousands of dollars. So it's really essential to understand the limitations of your coverage and take any proactive measures to prevent leaks and water damages in your home. I have heard of a lot of insurance companies, especially for condos, renters, that they have been requiring leak detection systems, for example, before they renew your policies. So that is something for sure to consider. Some other perils that aren't typically covered are like termites, mold, and many other things, right? So this is all going to depend on your policy. Your best course of action is just to call your agent, call your company, and ask them, what am I missing? Get a clear picture of what is covered in your policy and if they meet your needs, because the worst time to find out that you're underinsured is after a catastrophe. So I've read various reports that indicate that 8 out of 10 homeowners are underinsured. Simply put, if they were to have a total loss today, 8 out of 10 people would not be able to rebuild their home. And unfortunately, like I said, most homeowners don't know they're underinsured until it's really too late. Being in Southern California, many of us are concerned with wildfires and earthquakes, but the torrential rains this year brought on catastrophic floodings in areas of Los Angeles, San Diego County, and the majority of these victims did not have flood insurance. And they're not alone. In general, about 2% of California homeowners have flood insurance. So it's a vast discrepancy, even in low-lying parts of the state. And so imagining that you're paying premiums every year, 20 years on time, but if you really did need to use a claim, it would not be enough to rebuild. That's why you guys are here today, and you're learning what are the ways that you can fix these things. What are the reasons you might be underinsured? Where do you start if this might be the case, right? So one thing I really want you all to take away from this webinar today is that rebuilding cost is not your home selling price. Your home would go on the market right now for $750,000. That is not the cost that it would make to rebuild your home. So if a disaster were to happen, you really have to think about all the new regulations that have been put into place since your house was built. Any building codes, all of those things are factored in. So interior sprinklers are a good example. They're required for any new builds. If you have a house that was built before, I think 2010, 11, when the bill was passed, then you would have to add that to your home. So these types of upgrades can easily add 35 to 50% of your cost, additionally to rebuild. It's just sometimes the permits and themselves sometimes triple. And also, following a disaster, it's important to note that if a large area is affected, construction costs and lack of construction materials or crews or labor, all of that skyrockets. So it's even more expensive to rebuild your home than you would probably imagine. And it's really important to note, if you have a policy right now that's a replacement cost value policy or an actual cash value policy. So an actual cash value policy is not going to cover a rebuild. It will cover what it will give you. They'll basically give you a check for the amount of that a reasonable buyer would buy your home a day before whatever loss happened. So it's just going to be that seller's a cash value of your home. But a replacement cost value policy might cover the full replacement of your home. Some of those replacement cost policies will cover your policy limit plus a certain percentage above those limits to cover the cost of permitting and building upgrades, all of that. But it is important to review your replacement value policy every single year. That's something that you should talk to with your agent. You and your agent usually talk about the amount that you're going to cover your home for replacement costs, because when you bought it, it might have been $700,000 to $800,000 to rebuild, but If you were to do that now, the cost could have gone 3, 4, 5 times as much. So replacement value, checking and doing your home inventory, or your home owner's policy tune-up every year is really important in that regard. And you want to ask yourself, do I have enough coverage to rebuild? Ask your agent. If your agent cannot answer that question, you have to find a new agent. Many agents will reduce your premiums, which is, good in the short term, but in the long term, even though your rate might be competitive, you might be paying out or having a huge cost in the long term because your home isn't fully insured. So reducing premiums might be a good decision for the month-to-month paycheck, but again, you might be paying that out in the long term. And a home's a huge investment, so you want to make sure that you have adequate coverage to protect that investment. Another thing I really want to discuss is that most people don't know that their insurance companies assign a risk score to their homes and their businesses. People are really hungry for this information because if you know your risks and know what's going on in your property, you can take action to reduce any of those risks and make yourself and your home and your neighbors safer. So the Safer from Wildfires regulation passed by the commissioner in 2019 requires insurance companies to give you the wildfire risk score for your property. And they have to tell you how they created the score and what factors went into this score. And so this wildfire risk score classification must be provided to you 4 separate times. You can ask for them 4 separate times as well if you are in these situations. So when you apply for a new policy, you can ask for that risk score. Or they should be giving it to you. But before you renew a policy, before you're non-renewed, and also when you complete any sort of mitigation on your house. So let's say you got a new roof, and it's a Class A fire rated roof, you might be able to get a discount for it, depending on your insurance company. And you can submit that to your insurance company for within 30 days, and they can give you a either a new wildfire risk score, depending on any of the mitigation you've done, or just give you your wildfire risk score in general. And you have the right to appeal that score, which is really important part as well. If you're not satisfied with that response, let's say they're using data that is incorrect, maybe they're saying there's a tree in your yard that actually isn't there because they used old Google Maps photos, whatever that might be, you have a right to appeal that. And we can help you at the Department of Insurance start that process, but every consumer does have the right to appeal on that end. So let's say you can't find insurance, which is the case for many Californians today. So if you get a non-renewal notice, first contact your insurer immediately. Ask them if there are any specific actions you can take to mitigate your risk and retain your coverage. This is the time you can ask for your risk score if they haven't given it to you with your non-renewal notice. In California, an insurer must give you at least a 75-day advance notice before your policy expires. And so if you think that your non-renewal was unfair for any reason, you can file your complaint with us. Many times we're able to get that non-renewal reversed if the insurance company didn't give you enough notice. And you might also want to obtain coverage in the surplus lines market. This is definitely something you should talk to your agent about, but it is something to mention to them. Surplus lines are going to be your non-admitted insurers. So they're not backed by it's called the CIGA, the California Insurance Guarantee Association, which basically any of the big insurers are in this. And if they're not able to pay your claims, there's this fund available. Surplus lines do not have that. So it's important to note there's not as many protections for claims under our department because they're not insurers licensed by the state. But don't let that scare you. They might be based in a different state. They might be based internationally. But it's something to consider. It's worthwhile to note. A lot of these reinsurers are also might be huge companies with huge reserves. I haven't heard of any of these surplus lines going bankrupt. So again, if you're able to get that off on a surplus lines market, might be a little bit pricier, but it is a good place to start and look. Now, if you've exhausted all your options, you cannot obtain coverage in the traditional insurance market, the FAIR Plan may be a temporary solution for a standard fire insurance policy. So the FAIR Plan is the insurer of last resort. It's not a state agency. It's not a public entity. There's no public or taxpayer funding that actually goes into the FAIR Plan. It's called the California FAIR Plan. It's a little bit of the misnomer, but the state is not the one providing this insurance. It is a fire insurance pool. It's comprised of all of the other insurers that are licensed to sell and conduct property and casualty insurance in California. So any of the insurance companies, if you can think of their, jingle or their commercials, so State Farm, Allstate, all of those companies pay whatever their market share in California into the FAIR Plan. So again, the FAIR Plan, still private insurance. But it is a very limited policy. It's going to be a named peril policy only. It is only going to cover fire, lightning, internal explosion, smoke damage. That's it. It's not going to cover anything more than that. And it's only going to cover up to $3 million. And that includes the assisted additional living expenses that we talked about. That includes the structure and the contents as well. So that's $3 million in coverages all combined. So if you do have a FAIR Plan policy, then I really consider what's often called the difference in conditions policy, or that kind of wraparound policy. You might hear that term a lot as well. So that's going to be the companion policy to cover any of the other hazards that the FAIR Plan doesn't cover, like water damage and theft and premise liability. All of those things would need to be purchased additionally. And then that way you can have a more comprehensive homeowners policy that isn't just covering fire. So in the past couple of years, we've seen insurance companies have been limiting policy writing in certain areas. This is due partially to rising global inflation. The cost of everything is going up. But a huge part of this is the increase in natural disasters, the increase in the severity of national disasters. And this isn't just happening here. Every state is experiencing these factors to some degree. I mean, we're looking at all the flooding that happened in Asheville, North Carolina. That's, pretty inland. We had flooding here in San Diego as well. So all of these disasters and the intensification of these disasters is really creating pressure on this insurance market. And it's important to note that insurance companies, they're not public utilities. They're not your SDG&E or your PG&E. They're not nonprofit. They're not nonprofits. They are solely there to make a profit, right? So they're under no legal obligation to write policies. Unfortunately, there's nothing in our insurance codes or regulations that say State Farm needs to write X amount of policies. So their contraction in these policies, them writing less, them canceling more policies, is creating this issue where more and more consumers are having to go on the FAIR Plan as the insurance of first resort, which is definitely not what it's intended to be, and instead of the insurance of last resort. So this slide is really to talk about the sustainable insurance strategy that the commissioner unveiled back in September to address this insurance crisis. So one of the most important parts of our sustainable insurance strategy is increasing the availability of insurance in wildfire distressed areas. So using our prior approval rate authority at the department, insurance companies will write no less than 85% of homes in businesses in wildfire distressed areas. This is a pretty historic agreement between the department and insurance companies, and this should reverse the trend of a growing FAIR Plan and close the insurance gap. So the second part about this is returning FAIR Plan policyholders back to the traditional marketplace. So we want the FAIR Plan to be a smaller section of the insurance marketplace than it is now. We want to give first priority to the homes that have been hardened. So the homes that have the classic fire rated roof, that are following the Safer from Wildfires regulations, those ones are going to be returned back to the traditional insurance marketplace if they're on the FAIR Plan. The next important element of the plan kind of directly addresses the climate crisis that is fueling the insurance industry to make these decisions. So the commissioner is going to introduce regulations to utilize forward-looking catastrophe models, prioritizing wildfire safety, mitigation, and transparency. The draft regulation was just revised and put out today. So we're hoping to have these regulations in place by December 2024. That's the deadline. And what these models do is just effectively address climate change using these new risk assessment strategies. And that will keep insurance available or increase availability. These forward-looking models are right now, based on our regulations, not able to be used. So the way that insurance companies are setting rates and underwriting policies right now is by using 20 years of historical data. In the past 10 years, we've had some of the most catastrophic, expensive, deadly wildfires. So they're looking at only that data set and then setting rates using that information. With these forward-looking models, they're able to get more data about what homes and communities are doing home hardening, fuel reduction, prescribed fires. So all of these things that are great for wildfire safety will be included in these like forward-looking models. So there's going to be a lot more ability for insurance companies to set rates more appropriately based on the hardening that communities and homeowners have done. And we'll just basically acknowledge all of the benefits of investments that our governor, our legislator, everyone's been working on these last 10, 15, 20 years in wildfire safety. As of now, based on this regulation, they're just not able to use that. They have to use that historical data. So this will be changing. And this is another kind of important element in this, is that stabilizing our marketplace is allowing for California only reinsurance costs. So reinsurance is just a tool that insurance companies use to manage their risks. So insurance companies buy insurance themselves. This is reinsurance. So that they can continue writing policies and things. We're looking at allowing California only reinsurance costs to be factored into rates. And we want to make sure that you understand we don't want to have Californians pay for, disasters across the world. We want it to be very California only, specific to the risk that's in California. So all of these new strategies should entice companies to start writing policies again. Allstate, for example, at our last hearing for catastrophe modeling, which is the forward-looking models I was just talking about, said once we have these regulations in place that they're looking to write in all corners of the state again. So we're working really diligently at the department to make sure those are in place by December 2024. And then the rate filing process will occur, and we'll hopefully start to see those benefits soon. So this agreement is really historical. Companies that are wishing to use these new risk assessment tools are agreeing to write more policies in these wildfire distressed areas. And so we're, again, hoping to see those changes by December, and at least on our end, have those regulations in place. So the last few things I wanted to mention were about some resources that the Department of Insurance has to assist consumers. So we have a ton of informational guides on all lines of insurance on our website. One I really wanted to highlight was a home inventory guide. So this is just a workbook that you fill out. It goes room by room. You take inventory and list of everything in your home. It's tedious, it's time consuming, I know that, but it will save you thousands of dollars and hours of headache if you do have a loss, because your insurer will require a list of everything you lost and you want to claim. And so the more itemized and detailed that list is, the more you have to claim, the more you can get paid for by your insurer. It's also important to have this kind of in a digital format, because if you did have a fire or anything like this, having this as a paper would not be ideal. So taking videos of your home, walking room to room, and then updating this yearly or whenever you have a new purchase is really a great tool. And then the NAIC, which is the National Association of Insurance Commissioners, has an application on your phone. I think it's on the Google and the Apple Store, and you can take photos of your items and then you can scan barcodes to high value items. It's a really great tool as well, but whatever avenue you go, it's really important to have some sort of home inventory guide with all of your other important documents as well. The top 10 tips for finding homeowners insurance is also on our website. It will guide you through the process if you're being non-renewed, or if you're unable to find insurance. There's more tips than I gave there, and also some specific links to tools. So on our website, we have a homeowners insurance tool finder, and you can enter your zip code and it will give you a list of insurance companies or agents and brokers as well that might be writing policies in your area. It's usually a really long list, but given how many non-renewals and how difficult it has been to find insurance, it is a really good starting point to see who's been writing in your area. And we also have an annual consumer complaint study, so you can know where your insurance company ranks. So every year we report how many justifiable complaints are filed against an insurer. So as you're doing that search for an insurance company, if you can't find one, that's another good place to double check that, it's a legit company that doesn't have too many complaints filed against it. And then again, there's more resources available on our website. You can also call our hotline. There's a ton of information that they're able to give you. There's agents there that I believe they have like a 2-minute call response time. There's a lot of agents. They're usually very, very helpful. And then I've also included my email here. If you belong to any group, you want to hear more about the homeowners insurance crisis or stay up to date on things, send me an email. We can definitely talk. I can definitely come and present. I am, like I said, I'm an outreach analyst. This is what I do. I go out into the community and talk insurance. So I am here to support you all. And I'm going to pass it on to TNA to do questions.
Yeah, thank you. We actually at the moment only have one question. So if anyone's listening and you have any questions you want to ask Sharon, anything, please send them in now so we can kind of work through those. But the one we have right now is they understand that you can't give insurance coverage advice, but potential options in lowering insurance costs and I do think you addressed this a little bit in talking about how people are underinsured, but how you weigh those costs and benefits of if you think some things may be unnecessary, but the insurance companies may be suggesting you keep them. Kind of how, if you can go back over on how you weigh those costs and benefits of having extra insurance versus not having it and trying to be cost effective.
Yeah, absolutely. No, it's a great question. And I hate to say it depends, but it does depend on what your needs are, where your home is, what your risk is in general. For some broad picture things, let's say you're on the FAIR plan, for example. If you are doing the Safer from Wildfires regulations, which we do have a webinar that we've done about the Safer from Wildfires regulations. So I'm sure she'll link that information where it talks about what discounts you can get from certain insurers. The FAIR plan is already honoring these discounts. I believe Travelers and USAA might also be honoring some discounts. So there's certain things you can do to your physical structure, the outside of your home, making sure you're clearing that out. And then also FireWise designation. So if you are in a FireWise or a fire risk reduction community, those are two ways that you might be able to get discounts and lower the rates. As for like the decisions between, more coverage and a higher premium or less coverage and a lower premium, those are going to be really personal, and you're going to have to make those decisions with your insurance agent and ask them a lot of questions because it is going to be very specific to where your home is, how much risk you want to take on. And again, this is a big investment. A home is a huge investment. This isn't something you want to take lightly. So definitely talk to your agent, ask them a lot of questions about what they could do to lower your premium. Maybe you can increase your deductible. That's always a idea to lower your monthly premiums, but again.
Thank you. And then another one we got is what resources are available that may be specific to HOAs or COAs? And I know there's been some work on the FAIR plan on that, but any additional resources you may have would be great.
Absolutely. You can use a lot of the same resources that are there for residential insurance. It won't vary a whole lot with the steps. For HOAs, I didn't mention this, actually forgot to, so thank you for reminding me, but there have been a lot of changes to the FAIR plan. So it was approved, I believe, like a month ago. the FAIR Plan was expanding coverage for, it's usually $20 million per location. They're going to do $20 million per structure. I believe that's going to be starting next year. And so that should expand coverages for HOAs, for infill developments, some agricultural businesses and commercial businesses and things. So that should expand coverage. But as far as any difference, I would look at the residential coverage, call our hotline, or send me an email if you have a really specific question about your community.
And then someone asked, are receipts required when claims are filed? And how is the value of items determined versus what the cost was at time of purchase when getting reimbursed to go buy new items?
Yeah, a great question. You do need receipts for additional living expenses. So let's say you're displaced from your home for whatever reason, fire, leak, whatever it is, save all of your receipts for that. So anything in that, I mean, it doesn't hurt to have receipts for your actual personal belongings, but from what I've seen, it hasn't been necessary. What you need is an itemized inventory beforehand. So that inventory is kind of the most pivotal part of making those claims. And like I said, I gave you the options, either videos, pictures, or use some sort of app. And I do believe it depends on the policy on how they're going to allocate, if it's, you know, what you would pay for it right now versus what you paid for it back then. I think that might be a specific to your policy.
And then someone wanted to also have re-answered or clarified of the changes with the, I'm assuming it's with the sustainable insurance strategy. Are those gonna impact or go into effect for next year's premiums?
So this is it's a question I've been getting a lot, and unfortunately I don't have all the answers. So what I will say is that the department side of things is going to be done by December 2024. What happens after that is something called a rate filing. So anytime an insurance company wants to raise rates, change discounts, do anything, they have to go through the Department of Insurance. So now that these rules have changed, they're going to have to go through a rate filing. And then we look at these catastrophe models, we look at any of the changes that they want to make, go back and forth with their actuaries, financial representatives, whoever it might be. And so this process is what can take a while. So then once those are kind of into effect, which I mean, sometimes they take 6 months, sometimes they take a year to get approval, then, you know, they'll put those into place. And then over time, we should see those benefits, and we should see wider availability. And hopefully with wider availability, insurance companies are now competing for your business and rates will get more competitive. But that's kind of a long-term thing. I will say this is not going to be a December 2024, and by January 1st, we're going to see, you know, premiums that are less. I will definitely not make that assumption at all. This is going to be a longer term strategy to stabilize the insurance market. There won't be anything, unfortunately, that we can, you know, fix immediately.
Okay, and then is a wildfire risk score assigned to entire condominium association communities, or is it just individual units?
No, I believe when you have those commercial policies, it would be to all of it, depending on your location. I might be wrong there. I would like to, if you can give me their contact, I can definitely check in for you, but I would assume that it's the entire structure. It wouldn't be unit by unit.
And then this person said they've heard different advice regarding earthquake insurance when living in condos. One specifically with HOAs and their coverage versus the individual purchasing their personal coverage. And no, you can't give advice, but what are some things maybe to take into account when considering that?
I mean, I would say probably cost and what actually is covered. So if you have like a renter's policy that's covering your condo, or it would really depend on if you're owning or renting it. And so that would be kind of some of the considerations, but I would ask your HOAs already what coverage you have and go from there.
And then we are out of questions. So give it a couple more moments. I know this is a hot topic in our community. I know this is something I've frequently been asked about when I go to my community meetings. Now's a great time to ask them. We'll give a little bit more time, but
Absolutely.
if not, if
I
you have
also
any
have my
closing notes, Sharon, yeah.
Yeah, no, I have my contact there if there are any further questions or if you do want me to give more background on the sustainable insurance strategy or speak at any one of your events, I'm always open to doing that. I've been doing a lot of presentations with HOAs specifically and trying to get a better sense of what HOAs are and condos are really kind of experiencing because it's sometimes a little bit different than the residential homeowners market. But I learned just as much from these presentations as I hope you all do. I take this feedback back and talk to our leaders about what steps we can continue to make changes. So all feedback, questions, and everything like that is greatly appreciated.
And yeah, in your spiel, we have still not got any new questions. So thank you so much for your time. And I've been dropping a lot of the links and contact information and stuff in the chat. So we'll let that be open for just a little bit in case anyone needs to write that down.
Okay.
But thank you so much for your time. Thank you again. Like I said, I know this has been a hot topic in our community and lots of people. So really appreciate you going over this and walking us all through a super complicated process of the insurance state in California. So we really appreciate this.
Absolutely.
And then, yes, this has also been recorded. So if anyone wants to go back, it lives on our website under our video gallery. I dropped in the chat our wildfires one, which covers a lot of similar issues. It will be in that same exact location when you look at if you look at our wildfires one for future reference for all who attended. Thank you so much for taking time out of your day to listen to us here.
Thank you. Have a great night.